Welcome to the deep dive. Today we're tackling Nike, specifically their latest results, Q1 for fiscal 26.
Yeah, we've got the numbers in front of us, and there's a really clear theme emerging, wouldn't you say?
Definitely. It looks like a classic trade-off. They managed to get stability, stop the bleeding on revenue,
Right.
but it cost them a lot. Profitability took a big hit.
Exactly. That's the core tension. So our goal here is really to unpack that piece by piece for you,
Give you the full picture, the good, the bad.
and the calculated risks they took this quarter, get you the key insights without drowning in data.
Okay, let's start there. That first report really sets the scene. What was the headline win, and what was the immediate pain point?
Well, the headline was stabilization. Simple as that.
Mm.
After a few pretty rough quarters, revenue actually grew a bit.
Okay, so growth is back, even if small.
Exactly. It signals they've maybe stopped the slide. For a company like Nike, just getting things moving forward again, even slightly, is, well, it's a big deal.
A turning point, potentially. But you mentioned pain.
Yeah, this stability, it came with a really heavy price tag. Profitability got hammered.
How bad are we talking?
Gross margin, that's the key number here. It dropped 320 basis points.
Wow, 320.
Yeah, landed at 42.2%. I mean, for a company this size, losing over 3 full percentage points off your margin,
Yeah.
that tells you something aggressive happened.
Like heavy discounting, maybe?
That's definitely part of it. It immediately flags that getting back to profitable growth is going to be tough.
Yeah.
Especially with ongoing issues like in Greater China and problems within their own direct sales channels.
Right, so stability bought, but profit sacrificed.
That's the story in a nutshell.
Okay, let's drill into those financials then. Put some dollars and cents on this. Revenue hit what exactly?
Revenue came in at $11.72 billion. That's up 1% year over year.
Just 1%?
Yeah, and actually, if you adjust for currency fluctuations, it was down 1%. But crucially, even that tiny reported increase beat what analysts were expecting.
Ah, okay. So technically the turnaround has begun, at least on the top line. Expectations were low.
Right. But like we said, the real story is further down the income statement. That margin drop.
Yeah, what did that do to net income? Must have been brutal.
Brutal is probably the right word. Net income crashed, down 31% to $727 million.
Oof. Nearly a third of their profit just gone, while revenue is basically flat.
Exactly. And diluted EPS, earnings per share, fell 30% to $39.49. Now, interestingly, that 49 cents still beat the analyst estimates.
But the drop itself is just massive. It shows how intense the pressure is.
Absolutely. The squeeze is real.
Any bright spots? Like on the balance sheet, do they manage inventory? Okay.
Actually, yes. That's one area where they showed some discipline. Overall, inventories were down 2% to $8.1 billion.
Okay, 2% down. But hang on. If they were discounting heavily to hit that revenue number, isn't lower inventory just a consequence? Is it really discipline or just selling stuff cheap?
That's a fair question. It's probably a bit of both, right? They definitely needed to clear out old stock, which is good for the future.
Right. Clears the decks.
But yeah, they paid for it with those lower margins, those discounts, which leads us nicely into how they actually got that tiny revenue growth. What drove it?
Okay, let's look at the drivers. Because this shows a big strategic shift, doesn't it? Almost a reversal from recent years.
Totally. The engine this quarter, it was the wholesale channel. Selling through other retailers.
Okay.
That surged 7% to $6.8 billion. So they really leaned on their partners to move product.
Which is interesting because for years, the narrative was all about direct-to-consumer, Nike Direct.
Exactly. And that's the flip side. The higher margin Nike Direct business actually declined 4%.
Declined. Wow.
Yeah, and what really drove that decline was a huge 12% drop in their digital sales. Online sales went down 12%.
12%. That's not good. That's supposed to be the future high-margin growth engine.
Precisely. So you have wholesale booming, which carries lower margins, and your high-margin digital channel shrinking significantly. That explains a lot about that 320 basis point margin collapse we talked about. It's a major strategic concern long-term.
Okay, what about geographically? Where did the performance differ?
North America was actually the leader in the recovery, up 4%.
Okay, solid.
Yeah, driven by strong double-digit growth in things like running and training. EMEA, so Europe, Middle East, Africa, also solid, up 6%.
But the big problem area continues to be?
Greater China, still the major drag, down 9% overall.
9%, still struggling there.
Big time. Weakness across the board, but especially footwear, which is down 11% in China. Until they fix that market, the global picture is always going to be weighed down.
And product-wise, any standouts or weak spots?
Apparel was actually quite strong, up 9%. That helped offset a small 1% dip in their core footwear category overall.
Okay, so clothes did well.
Yeah, but the big shocker maybe was Converse.
Oh, yeah. What happened there?
It fell off a cliff, down 27% to just $366 million.
27%. Why is such a massive drop for Converse?
Well, it tends to be more exposed to like general consumer spending, the lifestyle side of things. That often gets hit first when wallets tighten. Plus, you've got tons of competition in that retro sneaker space right now. It seems like Converse really felt the heat this quarter.
Okay, so let's circle back to that margin collapse. Why exactly did it happen? You mentioned discounting, the channel mix. What else?
Right, we can pretty much pin it on 3 specific things that all hit at once, and they seem to be getting worse.
Okay, number 1.
Tariffs.
Just
Tariffs. The hit from import duties is growing. They're now expecting it to cost them $1.5 billion a year.
billion. Wow. Up from what?
Up from $1 billion previously. So that alone creates about 120 basis point headwind on margins for the whole year. It's a huge ongoing cost they can't easily dodge.
Okay, so tariffs are over a third of the margin problem right there. Factor 2.
Factor 2. Heavy discounting. We touched on this. It was needed, to hit revenue targets, clear out that inventory backlog, but discounts kill profit per item. Simple as that.
And factor 3.
The channel mix shift we just discussed. When your high-margin direct sales shrink and your lower-margin wholesale business booms, your overall company gross margin just naturally gets compressed. It's math.
Got it. Did they manage costs anywhere else, like operating expenses?
They did find some savings there, which helped a bit. Total selling and admin expenses, S&A, were down 1%.
How'd they manage that?
Mostly through cutting back on marketing spend. What they called demand creation was down 3%, so they tightened the belt where they could.
But clearly not enough to offset the margin tsunami.
Not even close. And looking ahead, management's guidance for Q2 wasn't exactly cheerful.
Oh, what are they expecting?
They're actually guiding for revenue to decline again in Q2, low single digits.
So the stabilization was maybe short-lived?
Seems like it. And worse, they expect gross margin to drop even further, somewhere between 300 and 375 basis points.
Wow, even more pressure.
Yeah, and they said tariffs are still going to be responsible for about half of that drop. So the pain is definitely continuing into the next quarter.
Okay, that guidance really sets the stage. It tells you the margin recovery is a long haul.
Exactly. Which brings us to management strategy to fix this mess. CEO Elliott Hill talked about this big sport offense reorg. What's that about?
Yeah, the sport of it sounds like a major internal shakeup.
It is. They're realigning literally thousands of employees globally, grouping them by specific sport like running, basketball, football, training.
Instead of by function or geography.
Right. The idea is to make teams hyper-focused on a single sport, cradle to grave, sharpen execution, get products right, be nimbler, respond faster to what athletes and consumers in that specific sport need.
Okay, a big internal bet on specialization. Makes sense. But let's talk about the elephant in the room, that minus 12% digital number. Management actually said that decline was intentional.
Yeah, this is maybe the most fascinating and riskiest part of the strategy. They basically confirmed Nike Direct, especially digital, won't grow this fiscal year. Because they're deliberately pulling back on promotions. They're stopping the heavy, constant discounting online.
So they're choosing profit per sale over volume.
Exactly. They're sacrificing short-term guaranteed sales volume today, hoping to rebuild the digital channel as a more premium, full-price destination later on.
Training the consumer to pay full price again.
That's the gamble. Get average selling prices, ASP is back up, even if it means fewer sales for a while. It's about protecting brand equity long-term.
High stakes. If it works, brilliant. If it stalls out digital growth for too long?
Big problem. But they are pointing to some early wins from the reorg. Like, running that category grew over 20% in Q1.
20%? That's huge.
Yeah, driven by new shoe models.
Yeah.
Better execution, they say. And they're lining up big product launches for football, timing it for the run-up to the 2026 World Cup. So showing they can still execute on big category plans.
What about China, that 9% drop? How are they tackling that with this new structure?
A message there is it's going to be slow. They have this huge task of resetting thousands of their own monobrand stores in China to fit this new sport-focused strategy.
So a physical reset as well as strategic.
Right. But they did highlight inventory discipline there. China inventory was down 11%.
Yeah.
So, like elsewhere, they're clearing the decks, preparing for whatever comes next in that market, slowly.
Okay, let's pull back to the bigger picture. We have profit collapse, tariffs biting, a risky digital pullback, China still weak. Yet, how's the stock market treating Nike through all this?
It's kind of amazing, actually. The market is still incredibly bullish. The stock trades at around 36 times forward earnings.
36 times. That's rich.
Very rich. It's a significant premium compared to competitors like Adidas or even the fast-growing disruptors like On Running.
So the market still has immense faith in the Nike brand.
Absolutely. Faith in the brand's power and probably faith that this sport offense strategy will eventually work and restore profitable growth. But that premium valuation puts enormous pressure on management.
No room for error.
Zero. They have to deliver and deliver big to justify that kind of multiple.
Let's talk about distribution risk, too. They're leaning back into wholesale, reopening partnerships with places like Amazon, Urban Outfitters. That helped Q1 revenue, but what's the danger there?
Well, it gave them that short-term stability they desperately needed. But the danger is brand dilution, right? If you're discounting heavily and you're available everywhere, including mass channels like Amazon, does the brand lose its premium feel, its exclusivity? It's a tightrope walk.
Especially when you have these challenger brands nipping at their heels.
Exactly. You've got On, Hoka, Vuori, Alo, all these focused, nimble brands grabbing market share in key spots. They don't have Nike scale, but they are definitely applying pressure.
Okay, so summing this up for you, the listener, what's the real takeaway from Q1?
I think you have to see it as a calculated pause, maybe even a necessary reset. They clearly chose top-line stability and starting this big strategic overhaul over maximizing profit right now.
Right. It wasn't about winning the quarter. It was about setting up for the future, potentially.
Potentially. The tension is clear. You've got some decent internal execution, like in apparel and running, fighting against these massive external headwinds, the tariffs, the China situation, the risks in their own channel strategy.
So if you're watching Nike going forward, what are the absolute critical things to track?
I'd boil it down to a 3-point checklist. First, the margin floor. Can they stop the bleeding? Can they prevent gross margins from falling even further?
And that depends on
Reversing that unfavorable channel mix, getting direct growing again, and controlling the discounts without killing sales volume. That's number one.
Okay, number two.
The digital turnaround, that intentional managed 12% decline. It's only acceptable if it actually leads to higher average selling prices, higher quality sales, and eventually a return to profitable growth in the direct channel. We need to see that turn by early fiscal 27 at the latest.
If digital stays negative for too long, the whole strategy is questionable.
Highly questionable. And third, the China reset timeline. That 9% decline is bad, but it's manageable if management gives a credible path forward. When can we realistically expect stabilization in China, given this huge store reset they need to do? They need to articulate that timeline clearly.
Makes sense. So the easy part maybe was stopping the revenue slide. The hard part is now restoring profitability.
That's the challenge. And with that 36 times earnings multiple hanging out there, the market is placing a huge bet that this sport offense, this big reorg, can actually translate into fatter margins down the road.
Which leads to the final thought for you to consider.
Does that current stock price fully account for the wait and the significant execution risk involved in making this massive strategic shift actually pay off on the bottom line? Is the potential reward worth the risk and the time it will take?
Something to think about. Thanks for joining us for this deep dive.
And just a reminder, we are not certified financial advisors, and this content is only for educational purposes. If you are considering making any investment decisions, please consult a certified financial advisor.